We've just had a tweet from the president, literally in the last couple of minutes. The Wall Street Journal has it wrong. We are under no pressure to make a deal with China. They are under pressure to make a deal with us. Our markets are surging. Theirs are collapsing. We will soon be taking in billions in tariffs and making products at home. If we meet, we meet. And he actually puts a question mark after that. So there's a lot to digest there, but basically I think the president is trying to say that the Wall Street Journal's story is wrong, that there is no pressure to make a deal with China, and perhaps there isn't a negotiation already underway to stop these tariffs.
I think that, when we hear the news like yesterday, that Mnuchin purportedly had reached out to Chinese officials to have another meeting, and you can see that how much markets can be roiled by trade with every tweet or every mention of what may or may not happen.
I mean, how much, but also how, the move was sharp, and it's sharp right now when he's tweeting this, but it's still not very big.
No, it's not very big because I tell you, my sense when I have been marketing around Europe and around South America over the last month or so, it does not feel like clients are fully set up for the next round of tariffs to go through. So I think it will be a negative surprise to markets. It does not feel like it's in the price. And I think that we think there's a significant probability that this next round of tariffs goes through and that people should be prepared for that.
How much will it really shave off GDP, though? I mean, the consumer is in great shape. It's been spending. Every place from Tiffany to Target has been saying this. So, what's another couple of cents on top?
So it's a great point. I mean, thank goodness we are on such a strong fundamental backdrop. And it's one reason why we've not thrown the R word out there when talking about the U.S., when we're talking about trade. We've got so much fiscal support from the tax cuts, from the increasing the budget caps. With all of that support flowing through the economy now, which will continue into next year, it's really hard to hit the economy hard enough, at least in the U.S., to cause a recession. Now, we have done these exercises. We've been taking the same approach as Chair Powell. We won't forecast on what may or may not happen, but what we've done is as tariffs are enacted, we build that into our baseline, and then we provide scenario analysis around all the various scenarios after that. So looking at this next round of tariffs, we have calculated that it would shave about 0.3 off of global growth. That's 0.2 off of China, 0.1 off the U.S. And I would say you're absolutely right. Should we say who cares? The problem here is that one of the biggest unknowns when you're trying to gauge the impacts to the economy is financial conditions. What do you assume about financial conditions? Now, you saw the first $50 billion in tariffs go through with retaliation this year. And look at financial conditions in the U.S. They're extraordinarily easy, something that Governor Brainerd called an upside risk to the outlook yesterday. So do we assume with the next round of tariffs that you also get no reaction in financial markets? At some point, tariffs build upon tariffs that build upon tariffs. The global growth story is lost, or at least investors assume that, and financial conditions start to ratchet tighter in a nonlinear way. That's the big unknown. And so that's why right now you know that no matter how much it's going to shave off growth, it is downside risk to the Fed's outlook. And especially if these tariffs are announced before the September FOMC meeting, again, it would be a bit disingenuous if they did not mention something about the risk from trade in the statement.
It's also interesting when you talk about how it's perceived by global markets. It's not being seen in the numbers as of yet, right? I mean, we have these estimates for what it could take off GDP, but CPI this morning, PPI yesterday were more examples of that, where there were these predictions that we would see inflationary pressure because of the tariffs. It's not yet being seen because we haven't had perhaps the full complement of the tariffs being imposed. But is that also where we're going to see a big impact?
So we will see inflationary pressures rise next year with this next tranche of tariffs because it's primarily a 2019 story and because there is a key difference between the first round of tariffs and the second. It's not just the total size of it. It's what it impacts. So the first round of tariffs was really designed to have as little impact to the U.S. economy as possible. It was mostly impacting intermediate goods, capital goods. Less than 2% of those tariffs affected consumer goods, which is really where you hit the U.S. economy. This next round of tariffs, more than 30% of it are expected to hit consumer goods. So you will raise inflation next year on the back of those tariffs, and then the Fed has a decision to make. Are they so sure about their precision of inflation forecasting that they can tell exactly how much of the increase above expectations in inflation is natural inflationary pressures and how much is just tariffs? If you know exactly how much is just tariffs, then you should look through that as monetary policymakers because it's transitory. But are they so sure? And that's where the risk of stepping into rate hikes in a faster way to push back on those inflationary pressures, that could become a policy mistake if after the fact you realize it was mostly driven by tariffs.